A crisis seems to be unfolding in the commercial real estate market. It's been much discussed, all thanks to lower demand for office space and higher interest rates. According to the National Association of Realtors, the U.S. office vacancy rate rose to 13.1% at the end of last quarter. That was an all-time high, despite more workers returning to work. Landlords are certainly feeling the pressure here, as are perhaps companies that build some of these buildings, unless they don't build offices, that is. That's where we bring in Bob Clark, founder and executive chairman at ClayCo, which is one of the biggest construction firms in the country. We were just talking during the break. You don't do as much office space as you used to. How do you think people are assessing the office space crisis? Are they doing it correctly? Are they underestimating, overestimating? Give us your read.
I think it's worse than people think it is, really. I think it's in inner city areas, urban cores like Chicago as an example. There's about 165 million square feet of office space in the Loop in Chicago, and I think that vacancy rate is as high as 50%. It's quoted by JLL as about 35%, so the national average might be 13 or 14, but in the cities, in the cores, in Los Angeles, Chicago, San Francisco, it's much higher and it's much worse. Of an overall impact on people in those communities and the economy, I think.
How have companies then at the same time been kind of revamping their leasing structure, trying to figure out how they can restructure the costs that they are paying in this interim period?
Yeah, I think there's a waterfall impact that also, it affects brokers, it affects banks, it affects the landlords and developers. It also impacts all the people that work in all of the support services and has a kind of disproportionate negative impact on minorities in the community and that sort of thing. So I think it's a really big negative impact overall, and I think it's going to take. I do think it'll correct itself over time. I think business people, leaders of businesses, want to bring their people back to work. We brought our people back immediately because we had so many construction people in the field that we didn't feel comfortable kind of working from home while our people were forced to work in the field. The banks, the big finance houses, the big real estate brokers, the architects and engineers are just now starting to really bring their people back to work, which I think is way too slow. But I do think that over a long period of time, the office sector will kind of self-correct and correct itself, and some of these buildings will find adaptive reuses and that sort of thing. But I think it's like a 5-year cycle, because I think it's going to take quite a bit of attrition, quite frankly, with the large employers to revamp their workforce to have people back in the office instead of in the grocery store.
And now, you said that you have dramatically decreased your exposure to office. Was that by design? Was that just a product of demand decreasing? How did that happen?
I'd love to say we're geniuses about that, but the truth is we started driving our capacity towards industrial as the market went from 200 million square feet a year during COVID to 400 million square feet a year. We continued to build 10% of all that product built. So that was really taking capacity away from our traditional office sector business. And at the same time, we really saw an opportunity in the advanced manufacturing sector. The chip manufacturing plants all started talking about building a couple years ago, 3 years ago. Today, all of those projects have come to fruition. The chips, the advanced manufacturing, the solar plants, the whole so-called Bidenomic-driven projects are really, really taking shape, and we're participating in that in a big way.
When you think about adaptive reuse, one huge shift that we have seen, or at least quest for more space, is in the data center side of real estate. Where have you been seeing even more of the cloud-centric companies or the data center-driven businesses looking at some of this real estate and saying, okay, if we don't have to build out something from the ground up, this might be advantageous for us?
It is an opportunity as long as they can get the power. And today, that's where the cloud is searching, right? Is where is there enough electricity? These projects are 40 megawatts up to 200 megawatts. That's a lot of electricity. And so you have to find places where there's a big substation and where the utilities exist, because all of the power companies, the Dominions and the Georgia Powers, are getting close to capacity. They can't add the capacity as quickly as the cloud is expanding right now, but this is going to be a big story in the economy. I think over the next 4 or 5 years, the booming cloud companies like Blackstone making tremendous moves into the cloud, and because that's where there's going to be a lot of demand, especially with artificial intelligence.
It's so interesting to me because on the one hand, you have Office, which is dead, and then you have all this other stuff that is going gangbusters from what it sounds like.
It's a tale of two economies, right? So in the piece I wrote for my team, you've got office and multifamily, you've got pressure from interest rates, which I don't think are all that out of control high. Honestly, if you really think 5-6%, that's a kind of a make sense interest rate. People make a lot of that, but I thought 2% interest rates were too low. I think that multifamily, office, and all those sectors are going to go through this really negative cycle, but I think the big story for the economy will be almost $1 trillion worth of projects in advanced manufacturing, chips, the cloud, and it's an overwhelming, and I think not completely well-known part of what's going to be happening in the economy for the next decade, but I think it's a decade runway for the top 100 builders in the country.
So that's good news for you. You mentioned interest rates, and of course the Federal Reserve is set to meet this afternoon, expected to raise rates again. This might be the end, but still, on a long timeline, maybe they're not that high. It is the highest in 22 years.
Yeah.
Have you seen any slowdown in financing for your projects as well,
Sure.
even in the areas that are healthier?
Yeah, I'm not sure that because of the interest rates, I just think lenders right now are trying to pile cash up, which they should be doing. And I think that lenders are not lending right now. They're just taking a more conservative approach. They want to see the fallout from the office and see what's happening. So I don't think it's interest rates when we model our developments right now. Obviously, the projects we modeled at 2.5% are getting hurt, but that's a short-term problem. If we're modeling projects now at the current interest rates, we're going to be able to do business. Not everybody will be able to, but we've got an integrated model, so we can sharpen our pencil on construction cost and make some of that up. As long as it doesn't get too high, and I think it looks like to me what the Fed is doing is working, and hopefully we're going to get the projected kind of soft landing now. But I think that whether the interest rates go up a little bit more is not going to be too impactful.
Bob,
as long as they start coming down a little bit in the next year or so.
Yeah. Bob, really great perspective, and thanks so much for joining us in studio today.
Hey, great. Thanks for having me.
Bob Clark, who is the founder and executive chairman over at ClayCo.